Do you want to buy an online business but aren't quite sure what you need to pay in legal fees or if you should be paying legal fees and or what sort of things are involved with legal fees and buying a business or legal due diligence? Hi, I'm Jaryd Krause. I'm the host of the Buying Online Businesses podcast, and today I'm speaking with Eric Shu, who is a business attorney committed to helping individual searchers escape corporate life and dive into entrepreneurship through acquisition. He specializes in the intricacies of business buying, and he provides strategic advice on deal structures and market trends. And as an active content creator, Eric shares a lot of valuable insights across the platforms like X, LinkedIn, and his blog, and aiding corporate professionals in their journey to becoming successful business owners. And he's strictly buy side, which is really, really cool. He does offline acquisitions, but he also does online acquisitions, e-commerce, and many different types of online businesses. And he has some great resources. In this podcast episode, we talk about legal due diligence. We talk about when do you need legal due diligence? What size deal do you need to start using legal due diligence on? What size deal typically is legal DD not really done on? What sort of the work looks like, what's involved, what sort of legal work is done with a letter of intent, legal work done with an asset purchase agreement or just a contract of sale, also work done in between an LOI and legal due diligence, what sort of searches they do to protect their buyers, and what work goes into creating a contract or an asset purchase agreement, how all of this legal work ties into using lending like SBA, and how your legal fees can be covered or be a part of your loan technically. And we talk all about that. We talk about how much the legal fees can cost for different sizes of different deals, what it looks like. We talk about what kills deals, and then how to prevent deals from dying, and also how to protect yourself as a buyer as well. So there's so much value in this podcast episode. I know that you guys are going to absolutely love it. I did. I really enjoyed connecting with Eric. Obviously, before we dive in, it's not the only way I can help you for free. If you are buying a business and you want to take the guesswork out of buying a business, make sure you get my due diligence framework, buyingonlinebusiness.com/free resources. It's what I use and it's what my clients use to do DD on deals. Now, let's dive into the pod and enjoy. Eric, hey, thanks for your time. Thanks for jumping on the pod. Welcome to the Buying Online Business podcast.
Thanks, Jaryd. Thanks for having me.
Yeah, you're welcome. Yeah, absolutely. So many questions. We had a great little catch up off air quickly, and I'm sure we're going to go down multiple avenues. So let's just get stuck in, I guess. For people who are looking at acquiring, as you know, we're mostly helping people acquire online businesses. Well, that's basically what we do. And there's a certain range that most people don't usually use a lawyer for contracts. Typically, I find under a certain range. What's the smallest deal that you've done and worked on in terms of like either drafting LOIs and APAs and contract of sales and maybe doing legal DD? What's the smallest one that you've done?
I've done deals as small as $500,000.
Yeah.
I think even one was like $205,000.
Okay. Yeah.
It happened to be where my client had just closed the deal and he said, "Hey, here's another one. Can you work on this one?" So I did the whole thing, and I think it was beneficial. We were working with a larger holding company as sell side, and so they're very professionalized, but they're also very corporate. So
Yeah.
by having counsel on the buy side, I think we were able to get things going pretty smoothly, got it done quite well, quite quickly. But yeah, I've done deals of all sorts of sizes.
Yeah, cool. In the online space, we see that as well. Typically, people aren't going to be using a lawyer for anything under the $500,000 range. And then you start to get your APAs written up because it costs money for legal fees and legal DD and everything when it comes to acquiring. And it can really dig into the purchase price if you're going for something low six figures, really.
Absolutely.
The next thing is like, when you do get into that range of $500,000 plus, what sort of legal, and in seven figures into the eight, what sort of legal work do most buyers usually need for online businesses? Because this is most buyers don't have no idea, right? And we need to sort of share like, hey, well, like, is it just help with an LOI, or does the people that you're using with SBA help you with LOI? Typically that can be the case, right? And maybe it's just a contract of sale or a little bit of legal DD. What sort of legal DD is you looking into? Is it entity searches and whatnot? So what's the typical amount of or type of legal work that you would do or people would
Sure,
need?
yeah. I get involved as early as pre-LOI when someone's looking at a deal, or they're interested, and they're thinking, how do I structure this? How do I fund it? How do I allocate risk appropriately? How do I price it? How
Mm,
do I present it in a way that the seller is going to be interested? At the same time, being fair to themselves and making sure to protect their own interests. And then at the same time, making sure that they're compliant with, as you mentioned, many of them are SBA backed buyers. So lots of competing interests there. So I start as early as pre LOI and help them review the deal, help them talk through risks, how to mitigate, help them talk through what the seller is likely thinking, and then different permutations of deal structure. For example, even a basic question like, are we going to do an asset purchase? Or are we going to do a stock purchase? And if we're doing a stock purchase, are we going to use one of those tax elections that gets us to treat it as an asset purchase? And then there's also something called an F reorg that is also complicated, often needed when it's a stock purchase. And talking through some of these things early so that we can memorialize them in the LOI, because I find that LOIs that have a lot of these deal points figured out and written down
yeah.
means the deal is more likely to close because there's fewer things that are going to be hiccups or they're going to be points of contention later.
Absolutely love that because the more in depth you have the LOI, the ease you can go through more of the revisions there in the LOI, and then when it comes to the APA or the contract of sale, there's less amendments typically, right? It's
Absolutely.
like sharpening the axe to chop down the tree. You want to do most of the preparation work of sharpening the axe before you just get the contract of sale written up and get the deal done. So, what are some? I'm going to ask you in a second around asset purchase versus stock purchase.
Hmm.
Park that one. But
Sure.
when it comes to LOI, what are some of the most typical things that you'd like to include? Other outside the difference of if it's going to be an asset purchase or a stock purchase,
Hmm.
do you like to include typically the deal structure as well? And what are maybe some other things that you like
For
to?
sure, the deal structure.
Yeah.
We want to make sure the seller knows exactly what the structure is going to look like because ideally we'd like them to go to their CPA and say,
Mm-hmm.
hey, if I sold my company using this deal structure, what am I going to walk away with at the end? How much money am I going to get? How big of a tax bill am I going to get? What am I going to net? And then for anything that's deferred, any sort of a seller note, any sort of a indemnity escrow, any of that kind of stuff, we want the seller to have some understanding as to how likely they're going to get it and how long is it going to take before they get it. Because for most of them, they have this time window, and it depends on what their age is. A lot of these sellers are in their 60s. Some of them are in their 70s. And if we say, we just want you to take a seller note, and they're like, well, how certain am I going to get paid and when am I going to get paid? A 70-year-old might say, well, listen, I have things for my lifestyle that I need now.
Yeah.
And I can't wait 10 years to get paid for it, for example. So we want all those things really set out clearly. We also want to let them know that certain things are required before we're going to buy. So we like to list out any contingencies, loan contingencies. A lot of times there's a lease. We want them to know, hey, SBA, for example, has requirements on this lease so that we need those met before we'll close. Maybe we want to make sure key people are still there with the business before we close. Just anything that will take out give the seller certainty about things that they need, and then B, address any of these potential deal killers early. If they think, whoa, that landlord is horrible to deal with, we'll never get over the line with the landlord. Well, then we better put our heads together and think about whether there's an alternative or
Mm-hmm.
not, because the last thing we want to do is get to the 11th and the landlord can't be reached and we can't close the deal even though everybody spent $100,000 on diligence and lawyers.
Yeah, it's so important to really sort of set the scene and set the groundwork before you go in and decide to spend a whole lot of money on DD
Absolutely.
because you could save yourself so much with just having a couple of good heart to heart conversations about open conversations about the business before you go and uncover so much before you go into proper DD, right?
Absolutely. Yeah, I think LOI is like the first test. If anything's going to fall apart, let's let it fall apart then, or if it's going to be some serious tough discussions, let's have it then. I mean, it's got to happen sometime, like paying now or paying later. Paying
Yeah.
later is more expensive.
Absolutely. And it's also good to be able to take the LOI to your lender and sort of see, hey, will we be able to get lending doing it this way with this structure for the buy side too, because I think that's very wise of a seller to make sure the LOI is set up in a way that they're going to be able to get the finances especially if they're retiring, in a way
Hmm.
that is structured that can be fair for them, and for them to just even communicate that pre-LOI and the buyer be aware of that, so the buyer can be like, okay, cool, I want to give you what you want, and I want to have that in the parameters of how we need to do it for lending as well. Those conversations really is the setup, right?
Absolutely. You make a really good point there. I usually try to get through one of my SBA broker contacts. There's one I do a lot of work with, and he's able to get it pre-flighted by a lender, which means they can sign off on the terms of the structure, terms of the seller note, because the last thing we want is for the seller to think they're going to start getting paid on their note right away. And then we bring it to the bank, and the bank says, oh no, seller, you got to interest only for 5 years or full standby for 10 years. And that changes everything. And we never like to have that type of a disappointing discussion after we bring it to the lenders. We like to get all those things early. And so they know exactly what the deal looks like.
For sure. Now, when it comes to online businesses, what sort of legal DD do you do outside of just contracts, like in terms of like LOI and contract of sale?
Yes. So after the LOI has been signed, we do quite a bit of legal DD, whether it's an online business or an offline business. So online businesses are unique because, of course, a lot of things are based on contracts, based on IP that's not tangible. There's not a location, usually, where you're going to go and look at machinery, do an appraisal, inventory count, anything like that. A lot of it is intangible, as you know. So we'll be looking at things like, do they comply with various laws on how they present themselves to the public? We'll dig into their website, make sure that's in compliance with the Can-Spam Act, with FTC rules on advertising, with COPPA, the Children's Online Privacy Protection Act. Did they get information from people? Did they properly store that? We'll also do very deep diligence on their reputation. So we'll be looking at their social media posts. We'll be looking at background checks on the owners and any of the key people in the business, just like we would for an offline business, just as important. We run the company through a diligence and reputation check to see what's out there in the news about the company, about the key people. We run their credit. We look for lien checks because that's just the same as as an offline business. One of the pieces with an online business that is not as critical with an offline business is we usually will recommend doing a tax diligence as well. A lot of times, online businesses that sell throughout the country may have tax exposure in other states other than the ones where they're farmed. And it's surprising how many online businesses aren't in compliance with tax rules. And that can be a problem that needs to be managed, a risk that is.
How do you manage that for risk if there is, they're not above board in other states for tax, for
So
illegal?
typically we would get tax diligence review to get an analysis of the amount of likely exposure. If it's a small amount, we might just have them do what they call the amnesty filings, which these are the states where you can say, hey, state, I've been doing business, sold to your residence. How much do I owe you today to be in your good graces guaranteed? If it's easy to do that, we might do that. Otherwise, sometimes we might need to do an indemnity escrow for a period of time and say, okay, it looks like we could have an exposure up to $100,000. Let's put that in escrow. We're going to wait a certain period of time, or maybe the buyer does the amnesty filings to see how many states they can get cleared, and then if they get any claims or demands by states to pay sales tax, and they've got a pool to draw it from. Or sometimes it's just a matter of offsets against the seller note. So sometimes we just might need a bigger seller note because we have more indemnity claim potential because of the tax problems. But it
Yeah,
starts with a
that's true.
tax diligence.
Yeah, it's awesome. It's two great ways to have it tied into the note or have just a indemnity escrow. And the seller would just leave that portion of those funds in the escrow to draw from, right? How typical is it that you see, like, in terms of seller notes, where do you see a lot of the note being left in escrow, or do you see it not a part of escrow? And what does that look like with SBA as well? Because sometimes, depending on how much funds people can get, the note will be a
Hmm.
different structure. What are your two typical scenarios that you normally see?
So we always have the note separate from the escrow. So it's
Mhm.
either one or the other or both. So sometimes if we have a note of a certain amount, say a typical deal is about 10% seller note. If we have more risk than usual, we might say we need a 15% seller note, and then we're going to agree that we can offset that note to account for any indemnity exposure or other losses. If there's an additional desire to, or they don't want to take a note and the buyer is okay, we can switch to an indemnity escrow structure. And that's a separate structure because the note just starts paying. And then we would just like say, okay, the principal of the note is less because of we need to offset it for indemnity. Escrow, we actually have to take money from either the buyer or the bank, and we'll park it with an escrow agent for a set period of time, say 18 months. And then anything that shakes out as far as indemnity problems or losses, then the buyer would go claim from the escrow agent and say, hey, I suffered a loss of $50,000 because I had to pay some tax bill, and then it would come back out as a reimbursement. The SBA is fine with either of those structures. The only thing that they can't, sometimes they do have a requirement that indemnity escrow proceeds get paid back to the bank to pay down the loan, because they can't have any of that be going to the buyer. But other than that, there's no issue with SBA loans in either
Yeah.
side.
Yeah. Cool. Yeah, it's nice to know, because sometimes for people that like want outside of risk as well, sometimes people that want to purchase a business that may be more than what they can afford in terms of lending, they could have a 10% or maybe max 15% note that's outside of SBA, max out their borrowing capacity. Would say maybe they can get 2 mil and the business is 2 mil and they're putting in 300 or 400K, maybe a bit less. But
Mm-hmm.
they can pay up to 2 mil for the business, but it works out being the business more valuable. And maybe it's like a $2.3 million deal and they need to have a note of 100K in the outside the SBA, right? Outside that
Right. I mean,
contract of
just to be
sale.
clear, the SBA always wants to know about it because it
Yeah.
needs to figure into their debt service calculation, but it's outside of what they're lending for sure. And I've seen, and especially with online businesses, I've actually seen even larger notes. I've seen as far as high as 20%. Sometimes because it's a little harder for them to find funding, I've found that sometimes buyers can command an even higher note to leverage even better, based on my observations.
Yeah, no, we're going through one now that's more than 10%. And because it can allow us to maximize purchasing price as well.
Yeah, absolutely. And sometimes that's a win-win because you can offer the seller what they're thinking it's worth, and
Yes,
then even have it
correct.
be a forgivable note so that parts of it get forgiven if the performance doesn't actually meet what the seller says it should meet and what it's historically met. So that can be a tool for that too.
Yeah, absolutely. Now, how do you work with, because I'm sure there's going to be a bunch of people thinking, all right, cool, this is great. Like when I need a lawyer to acquire an online business, what capacity do I start working with Eric? It depends. I've noticed different lawyers do different things. Sometimes they can do flat fees. Sometimes they can do like hourly
Mhm.
rate. What do you normally do? How do you normally structure it? Do you prefer to look at the deal and see what they want and then do a flat fee so people know, and then, or do you just do an hourly rate and take it as it goes? The next part of this question is going to be a difficult one to answer, because it's going to be, well, it depends on the size of the business and it depends on how much legal work the person does. But it'd be cool to also speak to how much should buyers and or sellers put aside for legal fees too. But yeah, first,
Mhm.
how do you normally structure? Do you do hourly or do you do flat fees, or what does it look like for you?
I hate hourly fees with a vengeance. I will
Okay.
not do anything on hourly.
Okay.
I personally, as a lawyer, hate it. I hate tracking my hours. I know clients hate it as well. No
Yes.
client should be worried about calling their lawyer to ask a question, or should be stressing out over their lawyer's bill and wondering how big that's going to be with all the other stresses of closings. Every single thing I do, since I'm a buy side only lawyer, M&A is all I do. I know how much deals are going to take as far as my work. So I flat fee every single deal that I work on,
Love that.
depending on how much diligence they want. I have two levels of diligence. I have like full diligence and light, kind of like quality of earnings, having a full and a light version.
Hmm.
And then I just give them a quote on a flat fee for the entire deal, handled from beginning to end. That's how I do them.
Cool. I love that. I've, with my clients, I've only said like, it's even when I work with contractors for my business, is I don't like to do hourly rates because you also don't know, like you can't track it, right? And
Hmm.
you
Oh
just
yeah.
you just don't know. And for a lawyer fee, you guys, you charge well, and so you should. You've done a lot of study to be able to get there. and you don't know, it can't be tracked. So it's so nice, like you said, with the stress of like, how much is it going to cost at the end of the day?
Yep.
Yeah. Also, there's opportunity as well. I don't think a lot of people realize is like with lending and SBA, you can have your legal fees put under that as well. How does that work? Just like I'd love for you to speak to people about that so they can know I can have this set aside if I need, but can I put it under the SBA and what does that look like and why and how does that work?
Sure. So the SBA will always require a certain amount of cash equity injection from the buyer slash borrower. So let's take a $1 million deal, for example. The SBA might say, go get a seller note for 10%. We'll lend you 80%, and we want you to bring in 10%. And of course, on top of that, there's guarantee fees and closing costs and all that. So let's set that aside and just say that those will be added at the end.
So they've put in, so it's $1 million deal and they put in
Hmm.
100K. And then
Hmm.
what was the other 100K for? Sorry,
The seller note
the
was going to
seller
be
note,
10%, so
10%.
100K,
Yeah.
and the bank was going to provide 80
80K,
percent, so
800. Yeah.
800K.
Cool.
There's going to be closing costs, but we'll leave that alone for now. We'll
Yeah.
just talk about the basic structure. The way the bank regards legal fees and financial diligence fees is it's part of the 100K that the borrower has to bring in. So let's say the legal fees end up being, let's just say 18 grand, and the financial diligence ends up being another 12. So you got 30 grand on diligence and legal fees. Then the borrower only needs to come in with 70 grand. They just need to show the 30 grand in receipts and then the 70 grand at closing for their equity injection. So that's how the SBA considers those as part of your costs. Or you can write in a check for 100 grand and then they'll pay you back whatever they were going to give you as far as working capital. That'll come back to you too, because most deals have a built-in amount of working capital as well.
Yeah, absolutely. It's a really good way to explain it is that whatever your deposit is, say it's okay, and you've got fees or you got your receipts, that you can take that. It's kind of like a deduction from your deposit,
Exactly.
right? Where you've got your legal fees can be deducted from your deposit, your DD fees and M&A advisor fees even at times can be deducted from your deposit with SBA. Yeah.
Yep.
Have you
Absolutely.
not have you noticed that possible with other sort of lending as well outside of just SBA? Like as SBA goes up to like 5 mil, maybe max 8 mil sometimes. Have you
Hmm.
seen other lenders allow that to be the case too at all?
I haven't seen more than a couple of conventional loans, and
Mhm.
I haven't been privy as to whether my client had to come up with the full amount of the injection otherwise. But just to answer your question on that, when it goes up to 8 million, it's actually 5 million still the maximum, but the
Yeah,
same
in the
bank
max
is
three.
offering a conventional loan and they're saying "Well, you'll pay off the two at the same time, pari passu, as they call it." So with that, it would still be perfectly acceptable to use your advisor fees toward your down payment.
Yeah, absolutely.
That's a specific SBA rule, so I don't know how it works with other lenders or
Yeah,
loan
yeah.
types.
That's why I was just asking. I know SBA is it's pretty standard. So in terms of fees, you mentioned, say, $1 million deal, maybe it's 18K DD and
Hmm.
also 12K legal. What's the typical range? What sort of prices should people know that they might need to contribute to legals for different ranges of business sizes, maybe like 1 to 3 mil or and then above and whatnot?
Yeah, 1 to 3 mil. I'd say for everything. I'm talking about legal DD and the transaction itself, anywhere from 20 to 30. And then a rule of thumb is somewhere at or slightly below 1% of the purchase price for deals above that is what the industry standard is. I know there's a lot of firms that are more competitive than that, but that's kind of how they should probably be budgeting. And 20 is about the minimum to get any deals done with full legal diligence and full representation on the transaction, handling all the agreements, negotiating with the seller counsel, working with the bank, getting it closed.
Yeah. Also, guys, we say this with that's very, very general. It's going to be dependent on the deal, how much DD you want, how full stack you want to go, and like how much risk is involved, right? So it could be more as well, or
It could be sometimes a little less
a
if you
little
want a
less
very,
lighter.
hey, a very little DD, I'm comfortable with this, just draft me up the documents and go. Sometimes it can be done with less too.
Yeah. Yeah. Cool. Cool. Um, a lot of businesses that are pretty straightforward, I do know that like they like to go with that is let's do it light.
Hmm.
especially with the people that I work with, being an advisor and me doing the DD and knowing a lot about the business and the risk, I can sort of explain that to them and give them the option. Hey, you can be super sure and do more DD, legal DD if you want, or this is pretty standard. And this is the level of risk that you would be taking on, whether you want to do more DD or not in terms of legals.
Sure. Yep. Have that conversation all the time.
Yeah, yeah. What do you see that causes most deals to fail?
I think the number one thing that causes deals to fail, is a combination of lack of respect, or anytime a seller feels disrespected. And I don't mean
Right.
that in kind of like a seller's fragile kind of thing, but anytime they expected one thing and then you come back with something else, they feel disrespected. If they think their
In
business
terms
is
of
is
price, like
worth,
they in terms of like the seller expected a certain price and it came back with something completely different. Is that what you mean?
it could be that, or it
Yeah.
could be we agreed on certain terms of networking capital, and then now you need more. They may feel disrespected. And if there's not a good reason, your deal is probably going to die. Or if you want them to, sometimes, like I said earlier, with terms of notes, if they expect, hey, I'm going to get this note paid off in 3 years because I'm lending you money to buy my business. And then you come back and say, sorry, but the bank wants you to not take any payments for 10 years, something they feel disrespected about because they expected one thing and you agreed on it. Now you're coming back and you're reneging on that, disrespected, your deal is probably going to die. So those are the things that are killing deals that I've seen. The number, going back to that first one, I probably saw 10 deals die in the last quarter of last year
Mm-hmm.
because of earnings not meeting requirements. And then the buyer needing to come back and say, sorry, we can't pay that. Let's talk about pricing. And then the seller says, are you kidding me? No way. We agreed on a price. Now you're changing it. That's it.
Yeah.
Doesn't mean that they're not going to come back later and say, well, we thought things through. But that to me seems to be the biggest deal killer is anything that disrespects one side or the other. But, primarily we're talking about a lot of times the seller is the one walking away. That's what causes it.
Yeah. That's the one thing, and I've spoken to a bunch of people about that on the podcast before, is that when you're selling your business and you're getting close to the deal being done, it's still not a done deal. And as the owner, you still need to run the business and still need to make sure that you're doing everything you can to ensure the business is going to be successful for the long term, because you might not sell
Mm-hmm.
it, right? Like,
Right?
don't drop the ball. Like, and also selling can be a marathon at times, depending on how big your business is and how much work is involved in you presenting information for due diligence. It can take time and it can be a slog. And you also still need to, at the same time, focus on your business growth and making sure the business stays stable. So one bad month doesn't cause somebody to go, whoa, hang on, I don't need to buy this. We haven't signed any contracts, so I can walk away. And in terms of working capital, not would you be able to explain that just so people can understand what working capital actually looks like, what it looks like, what it means, and how you sort of calculate it in the rawest version for people, most basic
Yeah,
version?
absolutely.
Yeah.
So working capital is, and I'm glad you brought that up because it's
Yeah.
often misunderstood. On smaller deals, it's hard for the seller to understand what net working capital is and why the buyer is expecting it. And at the same time, it's often overlooked by the buyer. And let me the best way to explain that is once you buy the business on day one, between day one and say day 45, you've got the business. How are you going to pay your bills? That's the question. And
Mm-hmm.
having net working capital on hand is how the bills are going to be paid. If, say, you're a widget maker and it takes 30 days for your customers to pay you after you ship out a widget, if you don't have any net working capital on board, you bought the business at day 0, day 15, you just finished making something for someone, maybe, and then day 30, you've got bills to pay, payroll, rent. Where does that money come from? Out of your pocket if you don't have networking capital because you just sent the stuff out and it's going to take 30 days for you to get paid.
And
So
you just bought the
networking,
business too with
right?
most
You
of
just
your
bought the
right.
business and you got an SBA loan to make payments on.
Yeah.
So if you don't remember, I mean, for buyers who don't consider networking capital, they are dead in the water from day one. So the nice thing about having an SBA lender is they will build in guardrails for you. They will not lend to you unless you've shown where the networking capital is going to come from.
Correct.
And there's
Yeah.
3 places it can come from. One is from the lender. So a lot of times lenders, especially for smaller deals, will just say, don't bother trying to get it from the seller because they're going to just like look at you with a weird look like, why are you having me leave money for you when you just bought my business? We'll give you networking capital, lower the price a little bit, and then we'll fund you. So that's number one. Number two, some people provide it themselves, not very frequently.
Mm.
Someone just saved up 300 grand to buy a business. It's not like they have another 200 grand sitting around to fund networking capital, but that is a possibility. And then number three, for larger businesses, it's common to have the seller provide networking capital. And networking capital can be cash or it could be AR too. So it could be AR for a business. Again, going back to the widget manufacturer, for widgets that they shipped pre-closing, if they say all that AR is yours, then you'll start getting money coming in the door from day one for things that were shipped out 30 days ago. And that's what's going to keep the business
Just
running.
AR for people, accrued revenue, right?
Yeah.
Yeah. So I will just say you're right. Like the bigger the bigger the business, the more working capital, the more stock standard is. Businesses under the low six figure range and under, they don't. It's not really even a thing
No.
in online
Even below
business.
a million,
Yeah.
below 2 million.
Yeah.
Yeah.
Yeah. So how do you, just for calculations for that 45 days or 30 days, how do you
hmm
calculate it? I know people are probably thinking in their head about how it makes sense to do it, but just for sake, how would you calculate it?
Yeah, usually I'm not the one calculating it. Usually I will rely on whoever's doing the quality of earnings or the financial diligence. And they will usually calculate it as they'll take the balance sheet over the last 12 months, look at current assets, which is typically going to be accounts receivables and inventory minus current liabilities, and then average it out for the year. And then they'll say that's what you typically have as the difference between the two is what's running the business. And that's what we'll use to say we want this much in net working capital on hand at time of closing so we can actually run the business.
Yeah, and it can be 30 to, so you'll have that whole year worth, and then you can divide it down to monthly or daily, and then work out what you would need for that 30 to 40 days of that working capital.
Right.
And
Exactly.
this can also be done with SBA as well, like the business plan. When you're getting SBA lending, you have to do a business plan, and it can be done under that
hmm
too with your lender as well, right?
It can be. I will caution you that it's not always as accurate as it should be, I've seen,
Yeah.
because the bank underwrites it based on just the basic information they have, and they're just protecting themselves. And all they need to do is check the boxes, and the SBA is guaranteeing 80% of the loan. So they're just doing the basics needed to make sure they have that SBA guarantee. At the end of the day, it's the buyer slash borrower who has to make those payments or go bankrupt. So
Yeah.
I always tell people, especially for a larger deal, when someone's signing a personal guarantee, get the networking capital assessment from your financial diligence provider who will do the deep dive, who will look at everything from very minute detail all the way to the bigger balance sheet and give you a definitive networking capital down to the dollar. That's what you should rely on so that you know you have enough because you're the one on the hook. That's what I always tell my clients.
Yeah, you've got, like, when you're at the end of the day, you're buying the business, you're taking the risk, and it's the risk of the
hmm
business and the loan and everything. And that's why you want to have DD done and lawyers on your side to protect yourself from that. Because it can, it can get ugly if you don't know what you're getting yourself into.
Absolutely.
What about communication in terms of like deals failing? Where do you see communication breaking down, and how and why? Because what I've noticed is that, like, why deals can fail is because either like it can take too long, and that can be
hmm
because we're waiting on certain parties to do certain roles, right? For example, it might be legal just needs a certain amount of time to do the legal DD, or finance needs, and we need to do financial DD, we need to do all these other types of DD, or we're waiting on documents from other people once DD's done and all that sort of stuff. And what I see is like if there's just waiting happening and the buyer and the
hmm
seller aren't communicating, you can clearly see that that's what kills deals, because people waiting, we're in our heads about it. Do you see that as well? And what other reasons do you see that communication can break down, and why deals can sort of die like this way?
Yeah, you got to bring up a really good point. Communication helps move deals along, and deal momentum helps kind of blunt a lot of these other problems. If
Mm,
buyer and seller are regularly communicating, Usually it means they're in friendly terms, there's a lot of mutual respect, and they're willing to solve problems. So deals where they're like weekly informal check-ins between buyer and seller usually go through the smoothest. If there's issues, they raise it, they deal with it, they move on. I should say that a lot of times when there's silence for a long time, it's a bad sign. It's never really good when you can't reach the seller and they're kind of just ghosting you, or you can't reach their advisors and they're like, no, wait, we don't know what the seller's been doing. We haven't been getting instructions yet. That's never a good sign. And that can lead, as you point out, some of that's inadvertent, whether people are too busy or the seller just doesn't have a good team together. Believe it or not, sometimes they'll hire the wrong people who maybe are litigators and they got to be in court for a few weeks. And then they do this deal in their spare time.
Yeah.
Bad sign. And they can drag things out, and then deal fatigue sets in, which is a real problem. And everybody's just like, oh, it's been 4 months, 5 months. Why isn't this deal closing? And everybody gets tired of it, and every little thing annoys them. And then finally they're at each other's throats and things go south. Regular communication, I think, is a fantastic tool. It sounds like you're a fan of it as well. I always recommend to my clients, if you're able to check in regularly, it solves all the problems. Brokers and intermediaries who will facilitate that, I think, are worth their weight in gold. I mean, they're the ones who are making sure this deal closes.
This is why those guys get paid, right? Well, number one, yes, for due diligence help and all that sort of stuff, but they drive the deal. And if you don't have somebody driving the deal, because then it can just, like, so many deals like don't happen when the deal,
Mm-hmm.
like with or without an advisor or a broker, so many deals don't happen because of this. If it's not being driven, if the broker's lazy, which there are so many lazy brokers out there, the deals don't happen, right? Because like you need somebody to drive it. And if you think about the seller and the buyer's interested, but they're also like, when you're getting into a relationship with somebody who's like, is this something that I want to do? They're interested, but they're not 100% sure. And so they should be, because they need
Mm-hmm.
more information. So they're kind of like, yes, but no, yes, but no. And the seller's like,
Mm-hmm.
well, I want to sell my business. Yes, yes, yes. And the pressure of that, and then the pressure from the sell side can be like, hey, like, let's move this along. And that can cause the buyer to sort of pull back a little bit, like, why are they rushing this? And so you have this dance. And if you don't have somebody in the middle that's like sort of holding space and navigating that energy and the communication, can push one side away. And it can also, if you don't have, like, a seller just doesn't want to seem too desperate as well, it can work the opposite way. If a seller doesn't want to seem too desperate, so they're not trying to push the deal, and the buyer's like just seeing, oh, how, like, this is interesting, but do I want to buy this or not? And do I need to spend money on legals and then DD and all that sort of stuff? You can have both sides be like not too interested in the deal, but they
Right.
could be very compatible, right? Like the two parties could be like, it could be an amazing deal for both of them, especially if it's a strategic acquisition. That's
Mm-hmm.
why those brokers, the right advisors, are worth, like, that's why they get paid, right? Because they make deals happen if they're right.
Yep. Absolutely.
Yeah.
Yeah, and yeah, that's exactly it. If you don't have someone who is basically captaining the ship, making sure things are moving forward, and that's trusted, you don't want the lawyer
Huge
doing it,
trust, massive. Yeah.
because usually they think you're totally working for the other side. We
Yeah.
don't want you in the equation. But the broker can usually pretty well play a neutral party. A lot of my clients will just call up the broker and say, hey, here's what's going on. Can you help me figure this thing out? Or what's the seller thinking on this? Everybody can usually look to the broker, the intermediary, whoever is quarterbacking the deal, as somewhat of a neutral party. So if they're going to do their work and get everybody checking in and communicating on a regular basis and keeping that deal momentum going, that deal resolve, I think that's absolutely key.
Yeah. And you bring up a really good point around lawyers. Lawyers are so good, and your job is to be heavily on the buyer's side or the seller side, whoever your client side. So
Mm-hmm.
both parties need to understand that. And my role as an advisor is to have, like, you make sure you have your client protected, but at the same time, it's realistic for the other side to accept. Because if it's not, then you've just got like lawyers are just like, this is why flat fees are so good, right? Because you're like,
Hmm.
you're not going to want to drag it out. Hourly rates, where a lawyer is super aggressive to their client, an hourly rate's awesome. Be as aggressive as possible, right? And cause
Hmm.
multiple amendments in contracts and stuff like that because they're getting get paid a bigger paycheck. Which is
Yep.
why I think it's such a great way to do flat fees, because you go, all right, I don't want to add hours. I'm paying a flat fee. Let's do this in the quickest possible time frame. That's great for everybody. The least amount of hours you do for the flat fee that you get is great. And the client wants that for you too, because they want the deal to
Hmm.
work faster, right? That's the qualm with lawyers if they're doing hourly rates. It's like,
Oh, yeah.
well, let's not do too many amendments.
You're paid to be inefficient,
Yeah. Yeah.
incentivized to be inefficient. Let's put it
The
that way.
incentive is wrong. Yeah,
Yep.
absolutely. Yeah. Eric, it's been such a pleasure having you on. Thank you so much for coming on and chatting and just being open and sharing so much that you have shared.
Yeah, thanks, Jared. Really appreciate you having me. Anytime I can be of assistance, love being a resource. I do a lot of
Yeah.
teaching on social and through my
Yeah. Let's
blog
link
and
to that.
through my newsletter.
That's my next question. You've got your newsletter and you do a lot on social. What links can we send people to? We've got your website. Eric, how do I pronounce your last name? Shu? Yeah, ericshu.me. I'll link to that. I've also got your X here as well, your X link too. And you guys can check out his newsletter on his website too, right? You can get to the newsletter from
Yes.
your site, isn't it? Yeah.
Yeah, from my site, from my X profile, where most people find it. I try to share a lot of information to help buyers pre LOI and then kind of like how to work with lawyers, that kind of stuff to make them more sophisticated buyers. That's what I'm trying to do in the newsletter. I
Yeah,
think
I love it.
there's only so much I can do on a one-to-one basis when I'm working with buyers, just trying to
Yeah.
educate folks.
Because you're more so buy side, aren't you?
I'm 100% buy side. Yep.
100% buy side. Yeah. Okay. Cool. Love it.
Yep.
Awesome. Well, thank you
Trying to
so much,
educate
Eric.
buyers. All right. Well, thanks, Jared. Appreciate you having me.
Yeah, welcome. You're welcome. So welcome. Thanks for coming on. Everybody who's listening, thank you for listening, and I'll see you on the next one.